Hello, everyone. And Tegan is letting everyone in today. So be happy to see all of you guys. I know there's some of you on screen that were at the Chris Bird event here a week or so ago. Some of you have been on before. And I know that we just need a minute or so for Tegan to get everyone into the room. So Tegan, let me know when you've got everybody in. Looks like there's a couple people in the waiting room. I'm not techie enough to know how to let them in, so I'll let the experts do that. So, oh, hi, David. How are you? Missed you at the David Bird event. You would have loved it. Or
Yeah,
Chris Bird, sorry.
I had an appointment. Saul told me it was great. Yeah, next time.
Yeah. So some of the information today will be kind of an overview of some of what we talked about, or I should say Chris talked about. Some of it will be new, and some of it's preparation for kind of the end of the year. We'll have one more call. I think it's the end of November. Somebody can put it in the chat box, but which is really will then be all about getting you ready, to really get everything to your CPA. So today I wanted to go over a few things. And is my screen being shared? Can you guys see the slides? You can?
Yes.
Okay, awesome. Casey set all this up for me, so I so appreciate him, and I have no idea sometimes what you guys are seeing. So I'm glad you could see it. So the first thing I wanted to mention is Chris. He made a couple of statements the other day, and one was, Chris has been really in this space for about 25 years. But prior to that, he was actually an IRS auditor for 16 years. And as you know, we've been chunking down a lot of what he had last year. And now we're incorporating the things that he really talked about a couple weeks ago, because things are changing. So he always wants to make sure that we're the most informed. And there's a couple things today that I'm going to talk about that most of you are unaware of, and you need to be aware of it. He also encouraged you, if you want to take your manual to your CPA or the slide deck to your CPA, please feel free to do that. And he said, if you ask your CPA a question, for instance, about, the qualified business deduction or the Augusta rule or those types of things, and they have a blank stare, it's probably a good sign that you might want to get a new CPA. So let's look at some of these. The first one that he talked about, and these are not new, but the next section is new, is he talked about, 5 things that we should all consider if we haven't already done it. And the first one is really to consider the S corporation status versus a sole proprietor or an LLC or a PLLC. Now, here's what he means by that. He's not talking about the entity itself. The entity could truly be an S corp. It could be a PLLC. It could be an LLC. And what he wants you to consider is electing your tax status to be taxed as an S corporation. There are many, many benefits. I won't go through them all today. We've talked about it on previous calls, and so did Chris. But there's a lot of tax advantages that you can get if you have elected to be an S corporation for tax status. So there's 2 things. Remember, one is what type of entity you have. So in Arizona, most of us as real estate professionals are PLLCs, but you could be an LLC and you could be an S corporation. The second piece is, how do you want to be taxed? You could be taxed as a partnership. You could be taxed as an S corporation, and you have to elect that status at the IRS. Now, if you don't know what kind of status you have, you could ask your CPA. You could look at the letter that you got from the IRS when you elected your tax status. And if you aren't an S corporation, you can change it. And there might be some good reasons to do that. So I would be asking my CPA before the end of the year what kind of tax status I have. And if you aren't an entity at all, if you're still a sole proprietor, I would really consider getting an entity set up and getting your tax status selected as an S corporation. Again, there's just a lot of benefits to us who are in business to elect that status. It'll save you money on taxes. The second thing Chris talked about is making sure that you've hired an aggressive but legal CPA or an EA for tax work and planning. And I think sometimes we think we can't afford it. And I think he showed a variety of ways that if you are hiring a true professional, they can save you a lot of money. And oftentimes, sometimes, especially early in your career, you might, as I had, take the easy way and go to like H&R Block or go to somebody that can just put together the return. That's not what he's talking about. He's talking about actually sitting down with your CPA a couple times a year, talking about where you're at. Are you having a good year? Most of us are real estate professionals, so we may have had a good year. We may not have had such a good year. So what can you do tax wise to set yourself up for the best outcome? So making sure that you have a good CPA. So I have a CPA here in Arizona. I also have a CPA in Alaska that does my final returns because I'm a resident also of Alaska. And so making sure you've got a CPA. The third thing is sometimes I think we chase after, um, tax exemptions or tax credits that at the end of the day, as he says here, don't do stupid things to save taxes that doesn't make sense for your business. That's just true. And so sometimes I think we chase maybe some of those things, and the truth is, it may not be a good idea just because it will save you money in taxes. It may not be a good idea this year. So we'll talk about that in a few minutes about how if you've had a good year, what might be some things you could do, or if you haven't had as good a year as previous years. Again, what are some things that you could still do before the end of the year to set yourself up for the best possible outcome when it comes to how much money you may still owe the IRS or how much money you may be getting back. Also, when you meet more often with a CPA, they can prepare a cash flow statement for you and also a profit and loss statement. So if that's not something you're comfortable with, there's several really good companies here in Arizona that understand real estate agents and understand our model that could set you up very quickly. So if that's something you're interested in, I think most of you on the call know me. You know how to email me, and I will get you some of that information. Um, a lot of us, especially early on in our career, for me, I kept my money commingled, my personal and my business, because I didn't know any different, honestly. And while I did go to college at the University of Arizona and double major in finance and real estate, they didn't teach me how to be a real estate agent, and they didn't teach me a lot about finances. So for me, actually having somebody, I get a statement every Friday from my bookkeeper. So I have a CPA and I also have a bookkeeper. So my bookkeeper, Amy, every Friday sends me a profit and loss, and it's a year-to-date profit and loss, and it's also a profit and loss for that week. So I know how much revenue I received that week, what my expenses were that week. So I know I might end up having a bad week, but I probably am not going to have a bad month because I can start to see trends happening quickly and take action on them. Maybe it's I need to cut expenses, or maybe I need to really start, maybe I need to do more lead generation for revenue, but it's not going to surprise me. So rather than waiting every month and kind of being behind, it allows me to look forward and really see what's happening right now. So I get those statements every single Friday. And then number 5, keep your expenses in line with your income, and then plan where you're going to invest the difference. Most of us, I'll just be honest, as our income level goes up, as we are more successful in real estate, oftentimes our lifestyle and our expenses go up at the same rate. I will tell you, you don't have to really put yourself on a super tight budget for years and years and years in order to have an excess difference to invest, to start setting yourself up for growing your wealth. But you probably need to do it for a little bit. So I was pretty intentional about living beneath my means for a long time. I didn't drive new cars. As a matter of fact, the car that I have in Alaska right now, I was just home for a couple of days. And the car I have in Alaska right now, I call her Bessie, because she's 20 years old and she's still a great car. She only has like 137,000 miles on her. She's a Lexus, and she'll probably rust out before she quits running. So I was just willing to live beneath my means, while I was able to start investing. So, and I started with, when I started, really starting to invest, I was a single mom with 5 kids, and it was not easy. However, I just was super intentional for a few years that allowed me, and I didn't allow my lifestyle to creep up as fast as my expenses, and that really helped a lot. And 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 I will say this: sometimes it's hard when you see your friends with new cars or going on really, you know, fun vacations, and you're not. But I would rather be where I am today, because of some of the sacrifices I made then. So those were kind of his top 5 tax maneuvers that every business should consider no matter where they're at in their business journey. And then he really dove into a couple other things, that we'll talk about today. Um, he talked about the tax cuts, and he said, a lot of us may be sitting here thinking, depending on the election, or depending on some of the tax cuts that were started in 2017 from the job acts, are going to sunset. So the taxes and the job act of 2017 was over for an 8-year period of time. So some of the things that we've talked about, like last year or throughout this year, they're going to sunset in 2025 unless they are renewed. So right now it's 2024, and so we need to be thinking about what's going to happen in 2026 if they do completely sunset, and what that could look like. And some of the things that are being talked about is it could actually you could end up having potentially higher tax rates, both the marginal rates and in capital gains. They're talking about raising the capital gains tax. They're also talking about raising the marginal rates, meaning there's an effective rate and a marginal rate that you pay depending on what your adjusted gross income is. And they're talking about raising that, and also the capital gains tax. So what could that mean? Well, if the capital gains tax goes up, it might be another reason for you to learn more about a 1031 exchange. They've talked about eliminating the 1031 exchange for a long time. They haven't. I don't think they will. However, right now, these are the ones that really are being talked about. The third one, they're going to allow taxpayers to start more taxpayers will start itemizing their deductions because of the elimination of the SALT limitation. So the SALT limitation, what it did is, in especially states with high residential real estate taxes, they put a limit that you could only deduct $10,000 a year. Well, if you own a house in New York, you're probably paying more than $10,000 a year in taxes. So what they found is, once that SALT limitation was put into place, a lot of people stopped itemizing their tax returns because they were better off just taking the standard deduction. But with some of these changes that are being made, they estimate that more taxpayers will actually start itemizing again. Right now, 90% of taxpayers do not itemize. So some of the results of the changes in some of those of the tax cuts from the 2017 sunsetting could, as we mentioned, increase your tax rates. And so having taxpayers that might start itemizing is more likely, especially because they're also going to be lowering the standard deduction. So if you think about it, a few years ago when they put the SALT limitation in place, can't write off more than $10,000. They also raised your standard deduction. So they're going to lower the standard deduction. So more people are going to itemize. And if they eliminate that SALT limitation, then it will just mean more people are going to itemize. So what does that all mean to you? Well, if you haven't been itemizing in the past, you might not have been keeping track of what your interest was that you paid that year. You might not have been keeping track of the taxes that you paid that year, your state and local taxes, all of which might come into play if all of a sudden they lower the standard deduction. They eliminate the SALT limitation. You might want to start itemizing your deductions. And if so, and you haven't been keeping track of them, now would be a good time to start going and pulling out all of your records to make sure that you're ready. So at the end, we'll have time for questions, but I just wanted to point out that most of us don't pay attention until something happens to us. I'm just trying to raise your awareness that if these things happen, you may, like I said, 90% of people don't itemize, but you might want to start itemizing. So making sure that you have access to those records will be a good idea. What else is coming? Well, there's one thing that most of you probably aren't aware of. I don't know how many of you have heard of the Corporate Transparency Act. This is where you have to file a report with the federal government. And this is not the IRS. This is something completely different. And so if you do have an LLC, an S Corp, or a C Corp, or about 72% of all partnerships have to file this report before the end of the year if your entity existed already prior to January 1st. If you started a new one this year, you've got to report that one within 90 days of the original date of that entity. Filing this report, I filed 8 of them on Sunday while I was watching football, and it took me over 4 hours. The first one took me an hour. The rest of them were easy. So learning how to file it is kind of an art. If you call your CPA and ask, like I did, will you file this for me? The answer is no. No, they will not. They will refer you to an attorney. And I will just tell you, you don't need an attorney to fill out these forms. However, they're not as intuitive as you might think. So I printed off the book. So I went online to the BIOR and found their report. And I downloaded it, and it's about that thick, about an inch thick. And of course, that was a little light reading on Sunday morning, just to figure out what I'm supposed to file and when. And it was a little bit overwhelming to do the first one. However, once I processed the first one for one of my LLCs, so I had to process them obviously for the market centers, et cetera. And so there's a lot to do. And I would just say, if you are really struggling with this, give me a call. I'll probably say an hour's worth of frustration, just helping you see where they put the little plus check mark and the minus and all these other things that would confuse me. Maybe they won't confuse you, but they certainly confuse me. You have until the end of the year to file it. It's been sitting on my desk to do for a while. And I thought about it the other day, and I thought, if I'm like everybody else that waits till December 31st to file it, they're probably going to blow up the website at the government. And I don't want to be that person that gets a fine, because it's $500 a day if you don't file it on time. So that's a pretty big penalty. And then if they can prove that you had criminal intent for not filing it, then there's even more serious fines. So that's one thing. If you are an LLC, an S Corp, a C Corp, or a partnership, you want to make sure you get this done before the end of the year. And it's not difficult once you know the process, but it is required. So I'm sure that will make a lot of you happy, like it made me happy. Kidding. No, it didn't. But it's just part of business. So now let's talk about, well, what if you're having a really good year? What could you do? Well, number one, you could invest more of your profits into a tax-deductible retirement plan. There's lots of them out there. Talk to your CPA about what would be the best one for you to give you the best tax advantages. But that's certainly something that you could do. And you could still do it before the end of the year. As a matter of fact, most of the time, you can do it up until the date that you file, April 15th for the previous year. So make sure that you talk to your CPA about, if you have extra money to invest, what would be the right instrument or retirement plan to invest in, and by what date. Number two, consider maybe some faster depreciation or cost recovery methods. You have a choice when you buy an asset. You can either depreciate it or take 100% of the expense in 1 year, or sometimes you can expense them over 5 years, 10 years, 15 years. It depends on what kind of an asset it is. So, and I'm talking about, maybe I want to buy a new expensive laptop, or maybe I want to buy a new car. It would make sense to know whether it would be better for me to depreciate it over time or take the 100% of the expense this year if you are buying the right car, meaning the heavy SUV. When it comes to real estate, there are definitely some things, and we talked about cost segregation versus straight line depreciation. And those are just things that it just depends on where you are in your wealth journey. If I was super young, and I had bought a piece of property like a duplex, I would probably straight line depreciation that property over 27 and a half years. Or if it was commercial, 39 years. But at my mature age, I have done some cost segregation because I tend to be right now in my higher income earning years and want to defer as much taxes, or not only defer, well, yeah, it is defer as much tax as possible, um, and write off as much of the depreciation as possible and defer that to a later date. Now, if I just die, good news for my kids, they get a step up in basis and they don't have to recapture any of that depreciation. Kidding, but actually true. So that's one thing a couple things you could be doing if you're having a really good year. Here's another thing, not on the slide, that you could be doing if you really are having a great year. In December, you could pull. So there's two words I want you to know: pull and push. You could pull expenses into 2024. What do I mean by that? You could pay for something in December, write the check for it December 31st, mail it. Maybe coaching or something like that. You could pay for it in 2024 for 2025. So prepaying expenses. That's something I've done when I've had a really good year is I look for, well, who could I prepay so that I could write the expense off this year? And if the opposite is true, if I'm having a weaker year, I may want to push those expenses into the next year and pull revenue into this year. So maybe if someone is if there's revenue that I can actually pull into this year, then I'm going to want to do that and push the expenses into next year. What else could you do if you're having a weak year? You could consider converting some of your retirement plans to a Roth IRA, meaning if you have a traditional IRA, you could convert it to a Roth IRA and pay the tax. That might make a whole lot of sense. Or I'm sorry, say it in the reverse. Because as ordinary income, the conversion will be taxed at the lower marginal rate. So I said that right. So basically it's pulling that tax into this year versus, deferring it. So that might be another really great opportunity for you if you're having a weak year, is converting your traditional IRA plans to a Roth IRA and paying the tax now when you're in a lower tax bracket. And then consider slower methods of depreciation, so that you don't destroy income in the lower tax brackets. Because remember, you have a marginal tax rate and an effective tax rate. So you want to use up your, all the taxes that you can in those lower rates, because you pay so much on your taxes when it's 0 to like 15,000, and then so much from that to another level. So, this is why you want to meet with your accountant. I met with my accountant just here a week ago, to talk about where are we at, what is there anything I should be doing that we're not already doing that I should consider to make sure, because I don't know about you all, I'm not always convinced that the government is using my tax money in the best way. So I'm not a fan of paying them more than I need to. So I was asking her whether or not there's any other things I needed to be doing to minimize the amount of taxes that I'm going to be paying for this tax year. So that it's always a good idea to not wait until the tax year is over to ask those questions. And then let's look at, and I promise you we'll have time for questions. Let's look at what are the 9 most significant issues in the real estate taxation, actually, I would say in 2024. So again, these are things that might be on the chopping block or things that might change. One, as I mentioned, depreciation, section 179, and bonus depreciation. They're talking about those things changing, which would really be, you know, a lot of businesses are not going to make some of the purchases they're going to make if they can't depreciate them or expense them quickly. Number two, the qualified business deduction that goes away in 2026, actually in 2025. So in 2026, it wouldn't be available. What we've talked about that before, but the qualified business deduction is still available for you in 2024 and 2025. What does that mean? Let's say your adjusted gross income, meaning after, you know, expenses, let's just say it was $100,000. With the qualified business deduction, you're automatically not going to have to pay taxes on the top or the 20% of that profit. So instead of paying taxes with your net profit being 100,000, you will only pay tax on 80,000. So that qualified business deduction, you want to make sure that your CPA is checking the box so that you get credit for the 20% qualified business deduction, assuming that your business made a profit. So it's definitely something you want to make sure that your CPA is doing. They want to also potentially get rid of the Augusta rule. We've talked about that before. It's where you can meet in your home, your business can pay for it, and you can receive the income tax free. Cost segregation studies, again, they were always available for commercial, but they only became available for residential real estate, meaning under 4 families in 2027. And so in 2028, you could write off 100% of certain deductible items. Then it went to 80, then it went to 60. It's going to go to 40 and go to 20. So again, the cost segregation, which has been a great tool if you own something, a residential property under 4 units, that is going to sunset. So if you can take advantage of it between now and the time it sunsets, and it works in your wealth journey to depreciate the property more now versus later, then you might want to look into that before that sunsets. We already talked about the S corporation. The Section 1031 exchange, we talked about that several times this year. That is it's a great tool. They've talked about getting rid of it so many times, they haven't. Long story short, it's also a great way to be able to exchange into ultimately the property you want to live in when you retire. And that's another story for another day, but completely doable. And then the real estate tax professional status. Most of you on this call are real estate professionals. And because you probably qualify for that status, which again is something your CPA needs to check a box on your return, it allows you to take losses on real estate in the year that if you lose money. However, if you're not a professional real estate, if you don't have that status, you cannot take those losses until you sell the property or have a profit. So again, if you have any losses in any of your properties, you want to make sure that you have that box checked so that you can deduct those losses against your income in the year that you had the loss. Stepped up basis for most of us, other than maybe me and Frank on the call, probably doesn't apply. But the good news about stepped up basis is at some point, not anytime soon, but at some point, I'm probably going to move on to heaven instead of being here on earth. When I do, all of my properties will get a step up in basis to what the current value is, and my children will not have to they will not have to recapture any of the depreciation. So my long-term strategy, of course, has always been to buy and hold. The last set of properties I had before I 1031'd them into others down here in Arizona and then into Kansas City, I owned them for 17 years. So I'm a buy and hold gal, which means I've depreciated the properties a lot. So if I were to sell them, I would have to recapture all that depreciation. So instead, I just keep 1031ing them into something else. And then at some point, when I have an estate, which means I'm not here anymore, my kids would get a step up in basis and not have to recapture any of the depreciation. So that also can be not only a tax strategy, but can also be an estate strategy. And then the pass-through entity tax loophole, it only became applicable in Arizona a year ago. And what it allows is for your entity to pay your local taxes and get a deduction for it on your as an entity, so your LLC, and also be able to deduct it on your personal return. They're also talking about that going away. So if you're talking to your CPA, you need to ask them about the pass-through entity tax loophole, so that your entity, your LLC, PLLC, S corp, C corp, can pay your state and local taxes, get a deduction for it, and then also you get a deduction on your personal return. So that's a great way to reduce your tax liability in your business if you've had a profit before the end of the year. And actually, I believe you can do it until January 15th. Don't quote me on it. Ask your CPA. But that's going to be going away. It hasn't gone away yet. So that's something else that you could take advantage of in 2024. If your CPA does not know what the pass-through entity tax loophole is, you might want to get a new CPA. So that was a lot. And I just basically said a lot in a short amount of time. I do want to let you know on our next one, which is November 26th, we all are going to talk about end of the year things. What are all the end of the year things you need to be doing to make sure that you're prepared when you meet with your tax professional? So what questions do you guys have for me? I know we talked about a lot. I wanted to leave plenty of time for questions. So what questions do you have for me? There's 41 of you on here. I'm sure you've got questions.
I do.
Go ahead.
In Tennessee, the corporations or entities get taxed, but the individuals do not. And so my CPA recommended that I stay just as an individual. So I keep the accounting separate and all of that, and treat it like a business, but it is not a business entity.
I'm not a CPA. What I
Okay.
can tell you is that there's so many advantages to if you are an entity versus not an entity, that it is shocking to me that that would be the advice you were given. I would get a second opinion because I
Okay.
don't know. I honestly, as I said, if you're a sole proprietor, you don't get the qualified business deduction. If you're a sole proprietor, and you're not an entity taxed as an S corp, you can't reduce your Social Security tax. There's just so many things you cannot do as a sole proprietor. So I would get a second opinion.
Okay. Thanks.
And if you do set up an entity this year, there you can't take advantage of it the whole year, but you certainly could for the last quarter. So I would definitely get a second opinion.
I want to ask something. I'm from Uruguay, from South America. So we have different laws, but something you said that struck me was you started investing and you got a duplex. So for us agents that already read the Blue Book and Hold and Flip, all these books, would you suggest to go for this duplex or triplex instead of the single homes? Because you can buy one place and rent it to two or three people at the same time?
So when to answer your question, I think it's personal preference. If you want to maximize your money, I would probably start with a fourplex, which is what I advised all my kids to do. Because in essence, typically with a fourplex, you can either live in one unit for free, or you could take the amount of rent left from that one unit, because usually 3 of the units will pay for the property. Or so you could certainly take the extra money and start saving it for another down payment on another property. Lenders understand if you are owner occupying a fourplex, and then in a few years you want to buy a duplex, and then in a few years you want to buy a single family. They understand that. They don't understand it in reverse. They don't believe you when you say, I'm a homeowner and now I want to go live in a fourplex as and have that be my primary residence. But if you start in reverse, start as a fourplex, you can actually buy it without having to prove that you're great at property management, and you can buy it with a 3.5% FHA loan or 0 down VA. So my older boys were both veterans, and so that's the first thing that they bought when they got out of the military They used their VA benefits to buy a multifamily property. They lived in one unit, and that's how they started their journey. So I don't think you're wrong either way. It just depends on how much money you have to invest and what your ultimate long-term plan is.
Well, right now I'm looking at a threeplex, and it's a small house, and there's two bigger 3 bedrooms, and I can buy with 5% of the money, and I can get a 15-year-old loan. And so I was thinking, okay, this maybe I live in the small one. I'm single, I have no kids, and then I buy another one and start playing Monopoly with this, because at the end of the day, with both rents, I can almost pay the monthly mortgage.
Yeah. So I would just say is have a long-term plan. So I would sit down, I took everything I learned and taught it to my kids, but no one taught it to me. And the best thing I ever did was get together with a CPA in the beginning, so I understand what the loan origination rules are. I understand what the loan programs are. I understand what I have to be able to qualify for. And so for me, once I understood, because remember, building wealth has rules. Minimizing your taxes has rules. So once you understand all the rules, then you can create a long-term plan for how you want to buy property and whether or not you want to live in them, or be a property manager, hire a property manager, all those things. But I would just say, make sure that you sit down with someone that can help you create a long-term plan.
Yes, have all the numbers at the beginning.
I'm sorry?
Have all the numbers at the beginning, from the tax point of view and from the lease point of view. Have everything, all the hidden bills, all the hidden costs, all the stuff, have it up front. Knowing all the hidden costs, the little taxes, the little, things that will come, so you don't do math errors.
I think there's, a lot of things, a lot of ways you can calculate things. I'm a CCIM, so you can calculate an internal rate of return. You can do all of those things. But here's what I can tell you. For me, I simplify it. What is my cash on cash return? And is that going to work for me or not?
Okay.
That's what I look at.
Okay, thank you.
You're welcome. Other
I have-
questions?
Yeah, I have a question, Kristan. So, since I'm new with the agency, or just new in general as a real estate agent, I'm glad that I went to Chris Bird's class a couple of Fridays ago. So that was awesome. However, I just wanted to know if I should go ahead and get on board with becoming a PLLC or whatever kind of entity before the year's over, or maybe I should wait till after. Since I'm so new,
I don't
and
think. I'm
No,
sorry.
go ahead. I'm sorry.
I would just say make sure you start the year having already done it.
Okay.
So as a real estate professional, it makes complete sense to be a PLLC. We have that in Arizona. We don't have that in Alaska. But what I would say is how you choose to be taxed as an entity, because you have to make that choice with the IRS. It's really important that you make the right tax, that you are taxed correctly as an entity. And you heard Chris strongly recommend that you choose to be taxed as an S corporation, because there's just so many benefits that you would have. And understanding, I think people get confused because they think they have to be an S corporation to be taxed as an S corporation, and you don't. That's a tax election that you're making based on the entity type you have.
Right.
So yes, I would start sooner rather than later, just because,
Okay.
as you get towards the end of the year, there's a lot of things that need to be done, and that might get set by the wayside. And you want to make sure you start the tax year in 2025 with it already ready to go.
Right.
And
And
also,
with that being
you're going to want to let your MCA know that you're now a PLLC, so they can pay you as a PLLC instead of an individual.
right. And so with that being said, I would have to therefore get that done and then register it before December 31st, correct?
Yes,
So
and
all
it's
that
not
goes hand in
difficult.
Okay.
It's not, yeah, it's not difficult at all.
Okay, fair enough. Thank you so much.
And most people are just afraid, and so they don't do it, and they think it's going to cost them thousands of dollars if they have an attorney do it for them. It's not. And most of the time you can just do it yourself. However, if you're uncomfortable, there shouldn't be any attorney that charges you more than $500 to get you set up.
Kristan, along the same lines as that, if changing over to an S corp, do you recommend that you have a certain amount of profit before you make that decision?
No. Well, let me back up. Are you asking if the IRS cares, or whether you personally should be making a decision like that until you're profitable?
That if I should be making that decision before I convert over?
Yeah, you can't run a business negatively for a lot of years, or else the IRS looks up and says, you're a hobby. You're not a business. So I would say if you believe you're going to be profitable, I would do it sooner rather than later. I'm not saying you can't have a loss, because there's been times in my life that I've had a loss. But if you have losses year after year after the year, the IRS looks up and says, you're not a business, that's a hobby, and we're going to deny your deductions. Other questions? David, you're quiet.
Actually, that answer that you just gave right there made me think. I want to make sure that the IRS doesn't think we're treating it as a hobby. So, yeah, I gotta get it back in the grind, I guess.
Yeah. Yeah. There were just so many nuggets that came out of Chris's class that we just don't think about, like, aggregating our rental properties together. So I'm not going to go into it because it's kind of a deep concept and thought, but just know that if you took this class and why did we bring Chris back? Because the tax laws change, and they're going to be changing again at the end of 2025. And just like knowing what they're going to be changing here next year, just in terms of the standard deduction, the SALT limitation going away, those are all things that you need to know so you can plan accordingly.
That's right.
So,
I agree.
spending $199 for a class that basically will save you thousands, so that you're prepared to know what's coming and how to set yourself up to take the most advantage of it. The government never says it's a bad thing to take advantage of the laws that they put on the books. There's a reason they put them on the books. They want us to engage them and take advantage of them, because they know that the private sector can do things the public sector can't. So they see themselves as a partner with you. I know it's hard to believe, but they really see themselves as partnering with you to get something done that the government can't do themselves.
So with all that being said, Kristen, since I'm kind of new here in Arizona, I really am looking for a good CPA, since I know nobody. And so if you could refer me to somebody, and you could send it to my email or whatever.
Can I just tell you, because
Yeah,
I'm
you
going to
bet.
leave this meeting and go to another one. So my CPA here in Arizona, and he's the CPA for all of our market centers as well. His name is Jonathan Miller.
Okay.
And he is our CPA up here in Phoenix. And his office number is 602-535-1197. The reason I chose him is he does a lot of returns for a lot of real estate agents. You don't want to choose a CPA that, has one client that's a realtor. You want somebody that knows our business. And then in Tucson, our CPA, just looking her phone number up, it's Julie Kluwer, Klewer, and her phone number is 520-545-0555. So those are the CPAs that we have. They understand real estate, and I think that's really important.
Yes, thank you so very, very much. Appreciate that.
Sure. Other questions? Well, next month on our final end of the year call, that's what we're going to talk about, is end of the year cleanup. What should you be thinking about? It's kind of a checklist of questions that, if you haven't really created a financial, plan for yourself, or a wealth plan for yourself, where would you start? What questions do you need to ask yourself? So it's going to be more of, for you to more introspective. I'm just going to ask the questions, and you're going to write down your own answers to really help you get prepared for, the years to come. Take advantage of the tax law, of course, but also just things that maybe you don't think about when you're younger that you think about when you're older, and vice versa. So not only tax law, but making sure that you're properly insured. There's just a lot of things to consider. I didn't know that there was any such thing as, for instance, as an umbrella policy for me to have over all of my real estate assets, also to have a personal umbrella over just me personally, like things you don't think about. And those are just extremes that I would just say, I'm going to just go through some questions to help you guys be thinking about what, do you have any holes in your strategy that could, so I think of it like the foundation of a house, the roof of the house. The roof of the house is all the protections to make sure people can't get at your assets if something bad were to happen, so a slip and fall or whatever. And so I guess because I'm in housing, I always think about houses. And so when I think about building wealth, I want to make sure I've got a good solid foundation, and I want to make sure I have a great roof over me to protect that house that I've built. So those are the things we're going to talk about next month. So I'll look forward to seeing you guys then. And if you have individual questions, you can certainly email me, and I'll answer them as best I can. But the number one thing is make sure you've got a good CPA. It is helping you take advantage of all the things that are available to you, so that you pay the least amount of tax possible. I'm not. I just that's always certainly my goal, because I'd rather take that money and invest it in real estate. That's what I've done. Hope you guys take advantage of those things too, and look forward to seeing you next month.
Thanks, everyone.
Thank you. Thank you so much.
Thank you. Great class.
Of course.